right now is the time to make sure that you have all your ducks in order on the operational side, because expenses are rising very fast and rents are not growing as fast as expenses are. So it's really important that you're focusing on the quality of your operations and you're watching each line, especially on your smaller properties. Every dollar counts.
If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McCleard. Let's go, baby. All right. Welcome back to Agents Building Cash Flow. I'm your host, Randall McCleard. Great to have you with us today. One thing that I have wanted to do is start going down the line of alternative assets and items that you could invest in. And so what I've done is I brought on some operators. On last episode, I interviewed Devin Elder. He's an operator in multifamily. And so we didn't really touch on exactly why I was bringing him on, but I want to bring operators on so that you get an understanding of what the different asset classes look like, how deals are structured in those types of assets. So it could be, again, through venture capital. It could be through multifamily. It could be storage facilities. It could be non-real estate related crypto funds and that sort of thing. So I'm going to bring on a number of people. And so today I've got Brian Alfaro on. He's from Blue Oak Capital. They're a multifamily operator. They're based out of Houston, Texas. And so we talk about his ramp up, his growth from no doors to where he is today. And so he's had a very rapid growth on assets under management that they have. We talk about why they picked multifamily and how they see the benefits moving forward in that asset class. Talk a little bit about the market, current market, what's going on. So it's a really good chat. I'm glad you're here with us today, and I hope you get something out of this episode. We'll have more just like this coming in the future. But today we are very lucky to have Brian Alfaro. So without further ado, let's bring him on. Let's catch up. Brian, welcome to the show. It's good to have you here today.
Absolutely, Randall. It's a pleasure to be here.
Yeah. So why don't you just start off and kind of give us a background on, where you are in the real estate space and what you work on and what you do.
Yeah, so we've been in the multifamily space. I'm one of the managing partners over at Blue Oak Capital. We've been in the multifamily space going on 3 years now, and we source core and core plus assets primarily in Houston and San Antonio, although we do have some assets outside of our portfolio that are outside those markets. And that's primarily what we do. In real estate, it's really important, I think, to focus on your niche. They say, the riches are in niches, so to speak. We've tried to stay really focused in these last few years on multifamily real estate in particular, because like I said, it's a really hard business. As you know, somebody who's in the game, it's very hard to get your first deal done, and it's hard to grow your portfolio. It gets easier over time. And focusing on multifamily is, something that was really important to us when we were getting started. So we have about 850 doors, give or take, in our portfolio, that we've been able to accumulate over the last few years. And we've been very blessed and fortunate. Obviously, we've had a great market. 2020 was rough, but then it, came out guns blazing 2021. My primary focus on the team is marketing and investor relations. So I have a big passion for making sure that we reach as many people as we can, and we try to have a positive impact as many people as we can, and that we're able to provide these opportunities for people who don't know they exist. Yeah, everybody from busy professionals, people like yourself, brokers, realtors, other real estate professionals, that they know what passive income is because everybody hears the word passive income, but do you really know what passive income is? And not only that, but what are the benefits that come along with it, the accelerated depreciation and things of that nature?
Yeah, I would love for you to dig into that a little bit, because that is the whole point. I think in the single family world, a lot of realtors and brokers and that sort of thing, agents, they just think that passive investment might be like a single family house. They buy it and then they've got some money coming in on the side. But I've found through a lot of trial and tribulation myself from investing in single families, that's not really the case. It's not exactly passive. It's really active. I create jobs for myself multiple times over by managing those things. So how would you describe, what's the difference in your world of passive investing versus maybe getting some monthly cash flows coming in on a single family deal?
Yeah, that's a great question, Randall. If you're a real estate professional or you're a realtor, or if you have a couple of single family houses in your portfolio, what you've really done or what you're doing is you've bought yourself a job. That's just, to be frank, right? Actively managing a small residential portfolio. Or if you're a realtor or you're a broker and your investment sales, it doesn't matter if you're on the residential and the commercial side, you're working. That's a job. It's transactional. It's not really passive income, and you're actively managing those assets on a day-to-day, week-to-week basis. it's almost like a second job, right? So that to me is active income. If you're brokering deals, if you're wholesaling, if you're doing residential or commercial transactions, and if you're buying residential properties and actively managing those properties on a day-to-day, week-to-week, month-to-month basis, you're dealing with what we like to call the tenants and toilets, so to speak, then you're actively generating that income. It's not really passive, even though it's not a day-to-day thing necessarily. Our definition of passive income is much different. Passive income is money that you're literally not having to work for, and you're not having to focus as much attention and time on, because you take that money that maybe you would have used, put it in a single family residential house, 50, 100,000, whatever, and you're putting it into a deal with a sponsor who is actively managing the deal on a day-to-day basis. They're dealing with the tenants, they're dealing with the toilets, they're managing the manager. They have a third-party property manager that they're using to manage that asset. And you're literally getting mailbox money, to use that term, so to speak, because the only thing you have to do as an investor is, there's a lot of work on the front end. You do have to vet the sponsor. You do have to vet the deal. And then there is month-to-month updates that you definitely want to make sure you are staying on top of. You don't want to drop $100,000 in a deal and then disappear for 5 years. Although we do know people that do that. You want to keep your eye on the prize, keep an eye on it, make sure the sponsors are managing it the right way. But at the end of the day, you don't have any day-to-day responsibilities. You don't have any active management in the business. And really your primary responsibility is to enjoy the ride.
Yeah. How do you guys, so if I were an investor in one of your deals, how would I know how that investment is performing? What do you guys do to keep me informed?
If you're passively investing in a deal, you need to make sure you're investing with a sponsor who gives you monthly updates. So for us in particular, we're going to put out monthly updates that are highlighting the performance of the property. This is everything from the story. Hey, what's going on? Sort of in call it a few sentences, just kind of high level performance. Also for the people that are very technical or very numbers driven, your engineers, your people that are very spreadsheet oriented, we're going to give you all the financial details as well, right? So we're going to give you the balance sheet. We're going to give you cash flow statements. We're going to give you everything you need to see on a rolling 12-month basis to understand how the property is performing. And you're going to get that in your inbox on a month-to-month basis to make sure that you're staying updated. Now, whether you choose to, review that information or not is completely up to you. But any good sponsor who understands the value of having a great relationship with their partners, whether they're active or passive, is going to make sure that they're transparent and they're providing that communication on a month-to-month basis. And then some provide quarterly, more detailed reports, but they're at least touching base with you on a month-to-month basis.
Yeah, just wanted to touch on that because that's key. You know how it's performing. You have the ability to look at as detailed information as you want, or you can just let it ride and say, I trust Brian. He's got me covered. We're good.
Yep.
All right. How would you characterize, I think from talking to you, you guys have done a few different asset classes as well. I'm not sure if you ever did any single family or anything like that, but what are the benefits of investing? Because I'm interviewing VCs, all kinds of different alternative assets that people can invest in and alternative investments. And so how would you characterize multifamily's benefits compared to maybe some other asset classes? Why did you guys get into that as an asset class?
Yeah, so I'll go over some high level things that are top line. Why is multifamily awesome? Why do we love multifamily? Yeah. The first thing, and this is subjective, is that it's an illiquid investment. We've seen over the past several months how volatile the stock market can be, how volatile the crypto market can be. Other asset classes have been decimated, right? Real estate is a hard asset and it's illiquid. Selling it is not easy. Selling it is not quick, especially in commercial real estate. It's a 3, 5, 7-year, 10-year plan often. And to me personally, the fact that it's illiquid is actually a benefit, because for me as a human being, guess what? I'm emotional. You're emotional. Everybody's emotional. And when we see things dropping or being volatile in value, we often make very emotional decisions. We want to sell it because we feel like it's at the top, or we want to sell it and maybe cut our losses, so to speak, because we see it maybe softening a little bit. But the fact that it's a liquid means I can't make that emotional decision. I have to go along for the ride. I personally like that. That's not for everybody. So that's definitely one of the biggest benefits of multifamily investing. Secondly, one of the second best reasons to invest in multifamily is it's one of the core needs that people need. What is the one thing that everybody needs? That's a roof over their head. Even people that you would argue that are homeless, they still have a roof over their head, whether they're under a bridge or they're in a tent or whatever it may be. You have to have a place to lay your head at the end of the night. And most people are in one or two options. Most people either live in a detached single family home, whether they're buying it or renting it, or they live in multifamily. They live in apartment complexes. Got some small pockets here where people live in, things like mobile home parks. But for the most part, the average American's living in a single family detached or in a multifamily apartment complex. We want to invest in things that are tried and true and that are timeless and that people actually need. People need a place over their head. And we've seen over the last several years on some of the data that there's been a big imbalance between the amount of housing that's been created over the last several years since the great financial crisis in '08 and where the population trends are going. There seems to be a disconnect between what we have and what we're going to need and what we're going to need. And from another standpoint, talk about affordability. It's a whole nother conversation. We've all seen, we're in Texas, how expensive real estate has gotten over the past, call it 2 years, really since we came out of COVID. A lot of people who used to be able to afford a home 12, 18, 24 months ago, they can no longer afford a home. And it's a combination of rising interest rates and purchase prices being very high. So what do you do when you can't afford a home? You rent. So we want to own things that people are going to need, which is why multifamily is so attractive. And then the third thing, I mean, there's a long list, but one of the third things I like to highlight too is just the benefits that come along with buying large assets and the accelerated depreciation that you get to take advantage of, especially if you're a real estate professional. If you're a realtor, if you're a broker, if you're any type of real estate professional, the accelerated depreciation that we get to capture year one through cost segregation, that can be a tremendous relief financially for you on your taxes on a year-to-year basis. Now, I'll always say consult your tax professional. Everybody's situation is different, but the benefits you'll see on an annual basis from that is just phenomenal. There's no other asset class, in my opinion, beyond commercial real estate that can provide those types of tax benefits, which is why we see some of the wealthiest people always have commercial real estate in their portfolio. And that's one of the reasons, me personally, I got into multifamily real estate, is I was looking around going, man, what's something that all wealthy people have? And it was always commercial real estate. Of course, they've got their stock portfolios, they've got different investments, they're in VC funds, different things of that nature, but they need some sort of tax benefit. It's not even always for the cash flow. We talk a lot about cash flow, especially if you're trying to leave your job or you're trying to replace income. But the tax benefits are something that can be a phenomenal benefit to you personally, especially if you're making great money and you're a real estate professional.
Yeah. Do you guys have a general idea on how much, like if somebody invests $100,000, like typically what do you see on a depreciation side year one that you can get? If I were investing in a deal, do you have a number? Yeah. Is it like 30%? Is it like 80% like of that investment?
Yeah, it's really deal by deal. The amount of tax benefits and depreciation you get to recapture is definitely deal by deal. It's something that you want to make sure you ask the sponsor when you're looking at a deal, because every deal is different. Some smaller deals are going to have less things to depreciate because they're smaller. They don't have the gyms. They don't have the amenities. They don't have the pools. Those are things that all affect your depreciation. Also, things that are newer. It's a scientific approach. It's a scientific engineering approach. Obviously, it's not something that I do, but typically, I will say typically, I'll put this pretty wide box on it. 50% is 45 to high 40s, low 50s is kind of the floor that I've seen on our transactions personally. I can't speak for every other asset class. This is in multifamily, larger multifamily, call it 50 plus units, especially if there's amenities on site. That's something that we've seen, and the larger properties could have more. We've had some cases, depending on your capital stack, if you bring in a large equity partner and they don't want any of the depreciation, there's a chance you could have 100% bonus depreciation year one. We've seen that before too. We did a deal late last year where we had a large check writer as part of the capital stack. They wanted a coupon. They just wanted their percentage cut. They weren't interested in taking the depreciation. So guess what? All that depreciation that they didn't take, we passed it on to our LPs. And on that particular case, there was over 100% bonus depreciation. Now that's not common. All of our deals are not like that. There's only one deal that's been like that, but it can happen.
Yeah. Kudos to you guys for structuring it that way and passing that on to your partners on that deal. Yep. Okay. Yeah. That's really interesting. So how are you guys right now in this environment? What are you guys doing to make sure that your firm is, positioned for either the assets you currently own or the things that you guys are buying? Like, what are you guys doing?
This is a great question. We had this conversation with a broker lender earlier today. Actually, we had coffee with a good friend in our lender broker network. And two things I'll really make sure that I want to highlight is one, focusing on phenomenal asset management. Right now is the time for everyone to make sure that you have all your ducks in order on the operational side, because expenses are rising very fast and rents are not growing as fast as expenses are. So it's really important that you're focusing on the quality of your operations and you're watching each line by line. What am I spending? Especially on your smaller properties, every dollar counts. You have to make sure you're just running these properties really well. And personally, one of the things that we believe too is that I think we're going to see a slowdown in rent. We're already starting to see it. So retaining residents is going to be even more important. The last thing you want to do in an environment where rents are slowing down and the market's softening on rent growth is you don't want to lose a tenant who's in your property, who's already lived there a year or two. You want to try to see if you can renew them, right? So focusing on the quality of your operations, asset management, resident retention, that's really important. The second thing you can do is if you're an operator and you're looking to get on the active side of these deals, I think now is a phenomenal time to be focusing on laying a foundation for you to raise capital, from you to nurture your investors, because my personal opinion is that there's going to be some phenomenal opportunities to buy over the next 12 to 18 months. There's a saying we've probably heard a lot on the internet recently from Warren Buffett, right? When people are greedy, you should be fearful. When people are fearful, you should be greedy. Well, right now, there's a lot of people that are scared shitless. They're very fearful on what's going on in the market. They've seen their portfolios drop. There's some questionable purchases that have been made in the last 12 to 18 months. So now's the time to be greedy and to be building your equity sources, building relationships with your partners, so that if you find a deal in 6 months, Randall, and it's 60% off, or let's say 30% off what you would have paid 12 months ago, you want to be able to close on that. Yeah. So you got to have those equity sources lined up. So now is a great time to be talking to investors, building your database out, setting up your CRM, making sure you're nurturing people with phone calls, regular touch points on emails, text messages, whatever it is, to make sure people know Randall is serious. He's looking for an amazing deal to provide you with a great opportunity. And when it comes, I'm going to be ready.
Yeah. So to that point, then what are the conversations you're having with your investors like? I mean, you just outlined some difficult times ahead in the sense of, expenses are outpacing rent growth.
Yep.
And how is that conversation going? And what's the market like? We kind of talked about this previously just a second ago. It's hard to find a deal right now type of thing. Either sellers aren't selling because they pull back and they've kind of seen what's happening.
Yep.
And so the only people who are selling are people who have to sell, and they're still, maybe they're valuing their property as if nothing has changed. The rates haven't gone, rents are still going to grow, 15% per year and that sort of thing. So what's the conversation with your investor like in this current environment? How are you protect their investment, and what's the pitch like?
Yeah. So for our current investors who have invested in our deals already, we want to make sure that they understand our number one responsibility is to protect their capital. And we want to grow their capital. You put $100,000 in one of my deal, I want to give you back 200. That's my goal. I want to double your money. That's kind of industry standard, right?
Yep.
But the first thing is always making sure you're not losing money. So it's really important to make sure that during times like today, where rent growth is slowing down and expenses are going up, and we're seeing some softening in occupancy and concessions and bad debt are creeping up, especially on your value add projects, we want to make sure that they know that we're paying close attention to all these things, and we're doing everything that was within our power to protect their capital. Now, I can't affect the market personally. I can't control what the Fed does and when interest rates rise. I can't control, we screen tenants and they come in and things are great and then they stop paying rent. But what we can do is make sure we have processes in place to try to prevent that happening. And just letting them know that we're staying on top of the asset management, and we're having calls with our managers on a weekly, sometimes twice a week, sometimes 3 times a week. Just keeping our eye on the prize is the way I like to describe it. So that's for our current investors, making sure that they know that we're in this for the long haul. These are long-term investments. Most of the deals that are in our portfolio are, less than 2 years old, and we've promised them a 5-year hold. That's kind of industry standard. This is not the time to panic, right? If you're in a deal for 12 months, 18 months, 24 months, which is, only 2 years out of 5, now is not the time to panic. We said it's 5 years. We're going through a cycle right now. Things are a little rocky, but we're going to hold on. And we've been fortunate enough that, our deals either have very high interest reserves. We have $600,000, $800,000 of cash sitting on the sidelines for interest reserve, just in case payments go to creep up, or our deals have interest rate caps on them to where they can't go any higher. We've hit our caps on our deals already, which is, not surprising if you're in this market, in this industry. Yeah. So, that was stress tested in our model, and it sucks. You're not producing the cash flow that we thought we were going to produce necessarily, but the ship is not sinking, and we just got to make sure that we get through the storm. Because my personal opinion is that maybe not next year, but maybe the year after, I think the floodgates are going to open, because we saw this during COVID. What happens when no transactions happen for 6 or 9 months? When the floodgates reopen, it was like a wildfire. We had tons of people that were ready to deploy capital. The interest rates dropped, the cap rates compressed, and when it was off to the races, and then we saw this wild, crazy demand because nobody bought anything for almost a year. In 2021 was a record, right? Because 2020. I think something very similar is going to happen where the next 12 to 18 months, there's very, very, very few transactions, and then it's going to pop, and then it's the floodgates are going to open, and we're going to see it. I wouldn't say it goes necessarily back to what it was last year, but you're going to see very, very high demand for multifamily housing. So that's my opinion. So that's for our active investors. For our passive investors, or for our people that we're trying to get to partner lists who haven't partnered lists before, we're just reminding them all the things that I just said. We want to remind them that real estate's a patient game. It's not a get rich overnight thing. It's not like the stock market where you just kind of buy in and sell, buy and sell, buy and sell constantly. You watch it like a hawk because you never know what's going to happen. It's a patient game. It's about being patient. But at the same time, some new real estate investors, whether you're in residential or you're in commercial, they spend too much time trying to time the market. They're looking for that perfect entry point, right? They're just like waiting for the crash, so to speak. You probably talked to some guys that have said that I'm waiting for the crash, right? Well, what I have personally seen and from people I've talked to is usually the crash ends up being in your rear view mirror and you missed it. You missed the prime buying opportunity because you were trying to time the market. So in our opinion, the best time to buy is all the time, as long as you can make the numbers work and you can, in a good way, you can underwrite it. You can do your due diligence and make sure that the deal is stress test on your pro formas. It can be a great time to buy all the time, as long as it's a good deal, right? And the numbers work. So our primary message is stay active. Don't be sitting on the sidelines. Be looking at deals. Even if you're a passive investors, look at the deals that are hitting your inbox. And if they don't check your boxes and they don't meet your criteria, that's okay. At least you're staying active and you're seeing what type of opportunities are out there. And you're going to be better in tune to know when to actually invest because you actually see something that meets your criteria. And the same thing if you're active.
This show is sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other secondary markets in Texas. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com. Because you won't know a deal unless you are staying in it. Okay, so yeah, great info. I appreciate that. One thing that I have been telling investors and talking to people about is obviously the inflation, right? If you have money sitting on the sidelines right now, you are losing, right? I don't know what the stated inflation rate was. I think the print just came out and it was a little bit lower, like it dipped just
7.7, I think.
Yeah, that's stated, but like what it actually is could be, 10 plus, 15 plus, whatever it is, right? I know we're feeling it in everything that we are buying and doing. So yeah, having money on the sideline, even if the deals now that are being presented are, 5% cash on cash type of thing. I mean, that's 5% rather than losing money on a, to inflation on a just sitting in the bank, right? So anyway, just one thing that's kind of more in the line. I didn't know how you were looking at deals now compared 2 years ago or a year ago even. Yeah, so obviously underwriting has changed. You're pricing in a much slower rent growth. So good to know some of those things. All right, Brian. So yeah, tell me, let's take it back a little bit. I'm kind of curious, like how did you even get into real estate? How did you get started?
I got into real estate in 2018. I was in my late 20s. Life was going well. I had a good job. Just gotten married. My wife and I bought our first house. I was reading a lot of books on how to buy your first house, how to make sure you check all the boxes and you pick the right realtor and you pick the right house and you ask the right questions and you do the inspections and option periods and, yada, yada, yada. And all these books had parts in them that talked a little bit about investing. And I was like, oh, that's interesting. I had never really thought about investing in real estate. And the more and more I dug into it and I started Googling, I started finding things like Bigger Pockets. I started listening to the podcast. I read Rich Dad, Poor Dad, and very quickly caught the bug. And as I mentioned earlier, I started to realize that all people that were wealthy, most of them, very, very large percentage of them had real estate in their portfolio one way or another. So I said, hey, if that's what these guys are doing, then maybe I should start looking at real estate as well. So in 2018, I didn't know what I didn't know, self-educating myself. I was listening to podcasts. I was reading a ton of books. I was talking to people. I was going to networking events, multiple times a week. And I was like, okay, well, I thought real estate was how much money do I have in my account? That's 20% of something. That's what I can buy. That's all I knew. I didn't know anything about commercial. I didn't know about multifamily. I didn't know about raising capital. I didn't know about partnerships. I just thought you take your money in your account, you go buy X house and you just hold it and you hope that there's a spread and that's your cash flow, right? But very quickly realized the more and more I started digging that model in particular, unless you have a ton of cash, it's not very scalable because at point, one way or another, Randall, even if you had $10 million in your bank account, you will run out of money if you're buying your own deals with your own cash. Everybody runs out of money, right? Yeah. So I started to realize, like, okay, how do I scale a portfolio without using my own money, using other people's money? And what really made the most sense to get me to my goal? And after buying residential housing for about 18 months, I realized that even though I still love residential real estate. I think it's great. I think it has a low barrier to entry. I think if it checks your boxes and it cash flows, which keep the lights on, so to speak, then you should buy it, because it's going to most of the time appreciate over time, as long as you're buying good neighborhoods with good schools and houses with good bones. But I started to realize that the cash flow that you were actually generating wasn't really cash flow, because even if you have an amazing residential house, and let's say it's making $500 a month in cash flow, the difference between your mortgage and your rent that you're collecting, that $500 isn't really cash flow, because one, you need to be setting aside money for reserves for when you need to turn that unit. Two, you probably are going to end up spending that money one way or another. And I learned that the hard way. $500 over a year is $6,000 a year. Well, if somebody leaves your house and you have to turn the unit, if they didn't take very good care of it, that $6,000, it's gone.
Yeah.
It's gone. Right.
Oh, yeah.
So I like to say that cash flow keeps the lights on. Equity is what makes you wealthy. So I started to realize that, and I said, well, this is not really scalable for me personally. I was young at the time, late 20s. I had a little bit of money, but I wasn't a millionaire or anything like that. So I started looking at commercial, and I started realizing how attractive multifamily was for some of the reasons I mentioned earlier in the show about, the things like 1, cash flow, 2, equity appreciation, 3, compared to residential real estate, you can actually force the value up. You can't do that in residential real estate. I can put $100,000 kitchen in a new house. Well, if the comps around the neighborhood or only say that's only worth 20 extra thousand, doesn't matter how much money I spend. Well, in multifamily, if every dollar of NOI I improve divided by the cap rate, well, that's just true value that I'm literally creating out of thin air. So that just made way more sense to me. So early 2020, right around the time COVID started, that's when I really I was like, all right, I'm done with residential real estate and I'm going all in on multifamily. Cody and John, my two partners at Blue Oak, they had started, working together in late 2019. And, once we all connected, we all realized we're here in Houston. We have the same short-term and long-term goals. We all really, really like working with each other. They're great guys. Two people you want to go and just hang out with. They've got amazing families, amazing wives, amazing kids. This relationship makes sense. Let's commit. Let's go long-term. And we were off to the races after that. And I went all in on multifamily. And we, it took us about 12 months to get our first deal done. But after that, the snowball started to roll.
Yeah. Awesome. I didn't know that. I mean, you've ramped up significantly in a very short period of time. So kudos and congrats on that. Yeah. So at an interesting time as well to get into the space. So I'm curious on the partnership side. So you guys, a lot of the time in multifamily and commercial in general, you can do a partnership where you have your own entity and somebody else has their entity and you guys go in on a deal together. So, but you guys came together as an actual partnership to create a business. How did you guys figure out that there was going to be, just in general, it's like, how did you come to that partnership? You guys just sat around and you're talking. Was it, hey, Brian, you're really good at talking to investors, so you got to come on? Were they hiring for something, or what was the deal? How did you guys actually get that going?
Yeah, that's a great question. And I always give advice to new investors that are looking to find partners or do partnerships. I always like to say, hold hands before you date, and then date before you get married. But we didn't follow that. We kind of got married early, but I will say we're the exception, not the norm. And it's because of something you just said, Randall. We had a lot of conversations very early that made us realize that we were a great fit for each other. So we had a lot of, call them strategy sessions, we did hold hands, so to speak, where we were going on property tours, we were on calls, underwriting deals together. This is before the Blue Oak Capital LLC was officially started and our names were all in the agreements, right? So we did go through that process. But once we knew that we were the right partners for each other and we each brought a different skill set to the table and that we could see this thing working, we committed and formed that LLC, formed that partnership before we went into the first deal. I don't think there's necessarily a right or wrong. I always like to tell people, if you're not quite sure and you're just not confident and comfortable yet, it is better to do exactly what you said, have your separate LLCs and kind of come in together on that one deal, do that one deal together, or maybe 2 deals, just to make sure that you guys are a good fit for each other. Because things change a lot when things get rough and there's money involved and there's, equity involved. You want to make sure you're in bed with the right person, because these are 3, 5, 7-year holds, right? Sometimes longer. Yeah. And that can be hard for a lot of people. But again, I think Cody, John, myself, we're kind of cut from different cloths, but we're all cut from the same cloth, if that makes any sense.
Yeah.
We have the same, again, short-term, long-term goals. And we ultimately focus on people first, money second. And that's something that is not always the case. Some people are more focused on the dollars and the money, and that's okay. There's no right or wrong, but you need to know that about your partners before you get married.
Yeah, good feedback. Yeah, it's always interesting. I was in another mastermind in a group, and it was interesting seeing everybody trying to come together and how people, that's just such a big question and could be an impediment to somebody's growth if they are not either open to partnering or figuring out how to get on a deal with somebody if you're really wanting to get into this space.
Yep.
So yeah, good feedback. Do you have any deals that are maybe like 506Cs or anything that you could talk about? Have you guys done any of those?
Yeah. So right now we do not have anything in the pipeline. All of our deals, with the exception of one, have been 506C. So our primary investor avatar, people we like to work with, are accredited investors. Yep. We really like to work with professionals who already have great jobs, who have high income jobs, but are looking for diversification outside of Wall Street. They have a great portfolio. They want to get exposure to real estate. They want to invest in commercial real estate, multifamily real estate in particular. Working with those accredited investors allows us to go out and talk to them openly about the opportunities we've done in the past and then opportunities we might have in the future. So 3 of our deals have been 506Cs. The last one that we closed was not, so I won't talk about that one. But the one we closed on in February of this year was a smaller A-class deal that we did here in a suburb here of Houston, Texas. Very similar to what you were saying, 5-year hold. We look for 6 to 7% cash on cash, and the low mid-teens on the IRR, 15, 16% IRR, and just kind of 5-year standard hold. Keep it simple. Don't try to complicate things. I know you probably you look at a lot of deals, Randall. Some of these deals have like crazy complicated waterfalls and
17 waterfalls. You got to have 16 different hurdles. Yeah,
that's right. Yeah. We keep things simple, man. We try to make sure you understand as an LP that there's a saying that a confused mind says no. So we try not to confuse our investors. We try to keep it simple. So don't have anything to share. I wish we had an offering to share with your listeners, but I would encourage anybody who's maybe interested in partnering with us in the future, reach out to us. You can always visit our website, which I'm sure we'll share at the end, or reach out to me directly. And we're always happy to, put you on our list. We try to keep a very exclusive, small list of people that we've pre-vetted to make sure that they're the right fit for the opportunities we're looking for. The last thing we want is somebody on our investor list who's maybe, let's say you're looking for C-class properties that have high risk, high reward. Well, we don't buy C-class properties with high risk or high reward typically. We're not the best fit for each other, so it's not for you to be on our list. So we want to go through that vetting process to make sure that you're a good fit first.
Yeah, that's great. I'm going to backtrack and kind of cover some of the terms that we just went over because I want to set it up.
Sure.
Because a lot of people that are listening may not understand like 506B, 506C. Those are SEC regulations that have come out. If it's a 506B, then it is non-accredited and accredited investors. You have to be sophisticated and you're limited to the number, right? Not to get in the weeds, but you can't talk about it. It has to be somebody that has a substantive relationship with you. And so that's why you're never going to hear us talking or promoting a deal that's private. It really is a private deal. But if you have a different type of offering, which is 506C, about it, you can talk about the deal terms and say, this is what we're promoting and presenting. So yeah, it's interesting important to know that obviously as an operator, what type of offering you have. So on your deal that you can talk about, I'm just kind of curious, can you kind of give us the numbers on it? Like, what did you guys buy it for? What was the per door? When did you guys close? Just because, let me set it up as an investor. If I knew nothing about this asset class, I would want to get an idea of, how a deal works, how they're structured so that I could come in and say, yeah, I get like, I'm going to have a 7-pref, 70-30 split, whatever it is. And so, yeah, if you could kind of walk through that, you will be the first one on the pod that I've asked this question of. So it'd be good to get like an actual deal numbers.
Yeah, I'll walk you through the whole story. The stories are always great because people like to talk about the numbers, but I think the story is even more important. This is a deal we put under contract at the end of last year. It was late November. I want to say it was late November, early December that we put this deal under contract. It was a smaller boutique A-class property in a market here in Houston that we were pretty attracted to, that we knew was gentrifying and growing and changing, going in the right direction. We saw this opportunity. And as I mentioned earlier, we really like core plus products, things that are not heavy lifts. So to kind of dumb that down, we don't like buying things that need a ton of rehab. We're okay with light rehabs, if to use that term lightly. But we really, really like, especially because late last year, everything was really expensive. So in my opinion, if you're going to pay a top dollar for any type of real estate, you might as well buy the nice stuff. We look at things based on cap rates. And here in Houston, a C-class property was trading for almost the same cap rate as an A-class property. It's not anymore, but it was at the time last year. So we said, hey, it doesn't really make sense from a risk adjusted basis to go out there and start chasing these value add deals at a sub 4 cap just for the opportunity to go and add value. To us, that was risky. So we started looking for A-class properties earlier last year in 2021. And this one popped on the radar, a little smaller than we normally would look for. It's 60 units, 60. Typically, from an operation standpoint, would prefer to have something as close to 100, but definitely over 100 if possible. But it checked all the other boxes minus the size of the deal. It was 2017 vintage. It was in a good area. We liked the construction of the property. We liked the rent growth potential. And then the fact that it was newer meant it didn't have a lot of headaches when it came to the CapEx construction side or our operating costs. So we went after it, and we were able to put it under contract, particularly due to our relationship. We were competing with another California buyer, which is super common. If you're here in Texas, you're usually competing with at least one California buyer. The fact that we were local gave us the advantage with the broker. The broker wanted to do business with somebody that was local, that they could build a long-term relationship with, because a broker building a relationship with somebody in California who transacts here only when times are good, that's not good for the broker. The broker's always thinking about feeding their family for the next 5, 10, 15, 20 years. So they want to do business with people who live here. So we were able to, we weren't the highest offer, but we had a great relationship with the broker. So we were able to put it under contract. It was a $3.7 million raise, if I'm not mistaken. It was a pretty simple, again, we keep things simple. It was just a straight equity split, 80-20. So 80% of the deal goes to our passive investors, 20% of the deal goes to us. Same with the profits. 80% of the profits go to the passive investors, 20 go to us. No pref, no hurdles, nothing crazy like that. Just a straight, clean.
Super simple, yeah.
Yep, super simple. So we closed on that deal February. It was the very end of February, and we're able to take it over. Obviously, right around then, call it March 1 it was technically March 25th, I think, when we closed on it. But starting March 1, we had our property management team in place. We were off to the races. That one, we pro forma. We brought an interest rate cap on that one because at the time, when we put it under contract in November, the Fed was singing that they weren't raising interest rates. And then around December, if I'm not mistaken, last year, December, January is when they started hinting at, hey, I think we're going to start raising interest rates. But all of last year, with the exception of, I think, November, December, the Fed was putting a lot of content out saying, hey, we're not raising interest rates. We're not raising interest rates. Well, we all know now that's BS. But we bought an interest rate cap anyway. We bought a 3-year 2% strike cap, which at the time we felt like we were overpaying for. I think we paid, I want to say we paid like $108,000 for it, which we thought was too much. And that same cap today is, I think it's close to $1 million, if not over, for that interest rate cap. So we're very happy we bought it.
How many months do you need that to run out before you recoup that money anyway?
Yeah, it's a no-brainer. Yeah. It's a no-brainer. Yeah. So we hit that interest rate cap on month 6, which is not what we planned, but it did happen, we're very happy. If only thing now, I wish I would have bought a tighter cap. So for any of your listeners who don't know what that is, it's just a ceiling on how high your interest rate can go. So we bought a 2% cap, which means that our interest rate can't go more than 2% above the rate that we put it under contract, where we closed on the day of closing. So so just really simple stuff. But
what's the plan? I mean, did you guys have to raise for any CapEx, or was it was so new that you guys didn't have to do anything, and so it's really just operating the deal?
This was a light value add deal. So what we were doing is, one, we were adding tech packages. So 2017 vintage, but had no technology on site. So smart locks, smart thermostats were really the two things that we were looking to pull from an amenities standpoint. Tech packages, we've gotten all that installed, and feedback's been great on it from residents. The other thing we wanted to do was we had a plan to install covered parking on some of the spots. Now it's 60 units. So I think it has 95 parking spots. So you wouldn't be able to put a ton of covered parking, but we had a plan in place to do that. We have not pulled the trigger on that yet. We've been preserving cash, obviously, for good reasons. Yeah. And then the third thing that we really wanted to do was we wanted to improve the signage. So when we bought it, it still had the wooden sign up front that said "Coming Soon, Opening 2018." And obviously the property was 92% or 93% occupied when we bought it. So it had been open for a few years, but the owner never swapped out the "Coming Soon" sign. Yeah. So we wanted to take that down, install a nice professional monument sign that was backlit and that looked really clean when you were driving by. So really simple light value add. We did some backsplashes in the units, the tech packages. The backsplashes are $250 a unit. So again, just a no-brainer to really get that value add. We've talked about towards the tail end of the business plan, when we're looking to exit, say year 3, year 4, year 5, we will probably take some of that CapEx dollars that we had set aside and do more of a proof of concept for the exit. Let's go renovate a unit and do more modern. Let's go do the white cabinets, whatever's in style at the time. I don't know what's going to be in style 3 years from now. Let's do a more a medium turn on that versus just doing backsplashes and tech and saying this is a renovated unit. We're going to do like a full whatever's up to, whatever's in style at that point. Maybe it's $5,000, $6,000, $7,000 a unit. We'll do like 2 or 3. And then we'll sell that when we go exit that deal. That'll be the value add proposition for the next buyer because it's 2017 vintage. So it was 5 years old when we bought it. Well, when we sell it, it's going to be about 10 years old. So it's going to be perfect for somebody to implement a phase 1 value add proposition.
Yeah, that's a smart deal. Because then the proof of concept, somebody comes in and they see that you've already got, I don't know, $200 more in rent for those units or something, whatever that is. Yeah, that's smart. Awesome. Well, I appreciate you sharing that because that's part of what I want to be doing. I want to, bring on real life deals and say, this is how it works. And so at an 80-20 split, whatever free cash flow is, it's being spit off, 80 goes to the partners and then 20 to you guys. So yeah, great. Curious to see how that goes. We'll have you on later and check up on any new assets or new offerings that you guys have.
Yeah, man.
I'm going to ask a couple rapid fire questions before we wrap up. I just like to do this, so what's your favorite pastime not related to your business?
Ooh, I'm a business nerd, so I feel like all my pastimes have something to do with business.
More business.
Yeah, I'm like reading a business book or reading a business podcast. So I would say my favorite pastime that's not business related is definitely going to be spending time with my wife and our family. So we don't have any kids yet. Cody, my partner, likes to say that I'm not allowed to have any until our portfolio gets bigger. So he likes to joke about that. But I love spending time with my wife. I love spending time with my family. We get so caught up in business that we forget that, we're really, when we die, nobody's going to remember us for how many units we have. That's not going to be on my tombstone, right? Brian Alfaro, 10,000 units. Well, I hope that's the number. They're going to remember you for the things that you do, right? So spending time, creating memories. My wife and I love to travel. That's probably my number one pastime.
Yeah. Awesome. I love to travel. We'll talk travel another time. So maybe you have traveled in the last 60 days. What's the best thing or memory that's happened to you or your family in the last 60, 90 days?
Ooh, that's a great question. Best thing that's happened to me and my family the last 60 to 90 days. I will say that one of my good friends, he proposed to his longtime girlfriend. So that's been fun. My wife loves weddings. And also one of my wife's friends, they've been engaged, but they just officially announced their wedding date. And my wife's helping plan the wedding venues and they're doing a Mexico sort of what do they call them? Destination wedding.
Yeah.
So that's going to be a lot of fun. So we're going to get to travel to Mexico late next year. I think it's October next year. And then for me personally, I just got back from Orlando for a Multifamily Mastery 5 conference. That was great, getting to travel, meet so many high level investors. And then we've got some other conferences coming up next year. And then my wife and I are going snowboarding, skiing, whatever you like to call it, in early January with a friend as well. So I'm looking forward to that.
What mountain?
We are going to Lake Tahoe, which I've never been before. I've only snowboarded in Keystone in the Colorado area, obviously, but I've never been to Lake Tahoe, so I'm looking forward to it.
Yeah, I was wondering if we're going to be in Breck in February. So nice. Yeah, every year we take a trip and guys, we all get together and we go out for the last, 10 years. It seems like we've been doing it. So a buddy of ours has a place out there on Breck. And so, yeah, we'll have to go sometime. Do you board mostly or do you ski? Board. Okay.
Yeah. So I am probably nowhere near as good as you. I just picked it up in 2020. Right before COVID was the first time I snowboarded, and then I haven't snowboarded since. So this will actually only be my second time. But I don't even know how many 100 times I fell the first time I did it. But once you get it, you start to get it.
Yeah.
And it's a ton of fun, man. I'm one of those guys it keeps you humble, right? Because if you're good at a lot of things in life and then you get on a snowboard, you're like, oh my God, this is so hard. Yeah. And you fall 100 times. And I probably fell 100. My butt was very sore. Yeah. But keeps you humble and reminds you that practice makes perfect, and you just got to get up and keep moving forward. There's that saying, fall forward, and that's what you got to do.
I honestly, we took our kids skiing. We went to Utah to ski this past year.
Nice.
Man, my kids are a little young, and so I got on skis to try to teach them, and it was just like a nightmare, me trying to ski. I'm so much better on a snowboard. So, all right, that's awesome. And then lastly, just name, one or two people who've been most influential to either your life or your success.
Yeah, that's a great question. I think it's important that in this business you have mentors and people you look up to. And that's why I tell people, they ask me all the time, why do you join these coaching programs? I've probably spent in the last couple of years $60,000+ on coaches and mentors.
Yeah.
And it's everything from real estate to non-real estate, right? So I will say, people that have had an influence in my life, I'm in the Jake and Gino program, and those guys have been very inspirational. Not always on the real estate side. Like, I'm not saying they're not awesome at that. That's not really where I needed a lot of motivation, but they're really good husbands. They're really good fathers. They're really good family people, and they're really good leaders. So it's something that's been very inspirational for me. And then secondly, I would say definitely my partners. Very blessed to have two partners that understand, what we're trying to accomplish, that understand my personal goals, that, see me for me, so to speak, and empower me to grow in the areas that I want to grow, to be a better business partner and ultimately be a better leader, but be a better entrepreneur, be a better husband, be a better father. So coaches and mentors in the programs that I've been through, and then also, just being around awesome people, great business partners, people like people that are in our network. Yeah,
that's awesome. I will say, just after having talked to you and how you speak and how you articulate your thoughts, that if anybody's out there that's like Brian, I'm looking for a partner like Brian. I want to. Yeah, that was it was how you guys came together and how, what you add to the team. I can obviously see you'd be an asset to working with those guys. So
I appreciate the kind words, Randall.
Yeah, it's awesome to have you on. How can people get in touch with you? If they want to ask you questions, or if you have an offering or anything like that, how can they connect with you?
Yeah. No, I'd love to talk to anybody who's interested in real estate. I'm like you, Randall. I will just talk real estate all day. I don't care what you're investing in. I just love talking about it. And so if you want to reach out to me and talk real estate, see what we got going on, learn more about what we do, or just have any questions in general, you can shoot me a message. I'm very active on LinkedIn, very active on Facebook. You can send me a message there. You can also email me at Brian, BRIAN, at Blue Oak Invest. That has an S at the end. .com, and I'll be happy to have a conversation with you as well. So don't hesitate to reach out.
Awesome. And we'll share all that stuff down in the show notes so that everybody has a chance to reach out to you. So awesome. Brian, again, thanks for coming on. It's great chatting with you, and catch up with you soon at some event, I'm sure.
Yeah. Thanks, Randall.
All right.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.